0.5%. Let's bring in Crossmark Global Investments Chief Market Strategist Victoria Fernandez and Main Street Asset Management CIO Aaron Gibbs. Good afternoon, ladies. Sorry, my fourth show of the day. All right, Victoria, let's start with you. Do you see the S&P 500 hitting a new record before year end, which would be obviously tonight? But more importantly, it's about 2024. Is this the year going to be technology 24? Is it going to be value stocks in 2024?
Well, I think it depends on some of the things that are going to happen. Obviously, we probably won't hit the high today. We see the S&P down, but we will obviously hit it at probably the beginning of next year or sometime during the month of January. But so much of the push that we've seen in the market has been because of the broadening out of the market. We've seen small caps and mid caps come into play. We've seen the seasonality of the fourth quarter, and the sentiment has been very strong as well. I think these things are going to turn around when we get into January. Obviously, seasonality moves. In a re-election year, usually that first quarter has some pullbacks in it when you have the current administration running again. So we could see some pullbacks from that. I think sentiment will change a little bit. So if it's a value or a tech space, maybe you have a little bit of both as sentiment starts to have a little bit of concern built into it. And that broadening of the market that's brought small and mid caps, if some of the risks that we see for next year actually come to fruition, I think you might see some of that broadening go away. And so again, we're setting ourselves up, I think, for market to pull back in the first quarter of next year. But look, tech is going to continue to do well because of the AI boom that's there. But I think you need to have some value stocks as well because there will be some volatility.
I'll come back to you because I want to pick up on that AI story with you simply because I'm wondering if AI is going to broaden out into other sectors, and that's actually going to be the AI boost that we get for 2024. But Aaron, I do want to go back to you on the issue of small caps because that's something that you've got your eye on, and you're saying maybe that's where the bets should be. Can you explain?
Right. So they've had a very exceptional past 2 months. Generally, you wouldn't expect that leadership to unwind within the first half of the year and continue that outperformance. Now, we're not expecting these double digits in the 20s, 30s types of percentage of returns, but certainly still outperforming relative to your large cap. So I think if we do see pullbacks, we'll see that much more within the large cap space because valuations are getting a little more stretched versus still valuations that we really haven't seen a massive expansion into extreme areas within those small caps. And so I think even if the rate cuts don't come as quickly as we hope, there's still a much higher reward to risk when it comes to those smaller names.
Yeah, and Victoria, let's talk about 2024 because we try to look at the bullish side, but also what is the bearish picture for 2024? What are the greatest risks right now to the market that you see potentially hitting?
Yeah, there's a few that I see, Cheryl, and I think, first of all, look, we always tell our clients, don't underestimate the power of the U.S. consumer, but I do think we're seeing some weakening in household balance sheets. I think we'll continue to see some of that weakening. We've seen delinquencies in credit cards and auto loans move higher, especially in that 18 to 29-year-old group where they have student loans that are coming into play. And if you take mortgage payments out of the equation, interest on debt has gone up by 50% for households. So I think we'll see some weakening of the consumer. That's a risk. There's obviously geopolitical risks that are going on, and then what it means in Washington for that. We still have to get many bills passed. We have to get a budget passed. There's going to be some volatility around that. And then probably one of the biggest concerns is going to be earnings. I really don't think that we're going to get that 11-12% earnings growth that the market has priced in right now, and then we'll have to see some repricing within the market if that doesn't live up to what it's thinking it's going to be. And look, earnings start in 2 weeks, so we'll get a pretty quick answer on where we stand there.
Well, and Aaron, look, mentioning the markets and kind of what their wish list is, it's for rate cuts. You've got the Fed saying 3 rate cuts. You got the market, Mr. Market, saying 6 rate cuts. I don't know where the difference is going to be, but I'm wondering if we're getting ahead of ourselves here.
I certainly think there's a possibility, and to another point, it really is going to be about the earnings. We've had the valuation expansion in 2023, so if we're looking for higher higher prices within the market for 2024, it's got to come from that earnings growth. And right now, the S&P 500 is expecting about 9%. It's coming down. That's normal. We start seeing revisions coming down. But we want to stay above that 5%, ahead of inflation, in order for the markets to end up higher. So even if we don't have to be completely focused on the Fed and every single day is really about what the Fed's saying versus what companies are doing, I think as the year goes through, we'll be more focused on what companies are doing and less on what the Fed is doing.
All right, Erin and Victoria, it's great to have you both. Thank you for that perspective.